Tell me about your New Year's party.
Yeah. Um, funny enough,
Did you go
kind of
out? You were out to
summarize. No,
dinner,
we were like
up all
our
night?
house, but we were supposed to go out to. We have friends of the family that little kind of do a real big like food spread. But
Like
one
formal? Do
of
you
the
get dressed up?
no, we don't have to get dressed up, which is always nice. But again, it feels like we're like back a couple years ago. Someone got COVID. One of the main people that helped
Yeah,
host
yeah.
it got COVID probably about 5 6 days before, and so we canceled it. So I ended up just doing the neighbors and their kids with our
Okay.
kids, which is great for the kids. I
Did
think
you let
actually
the
the
kids
kids
stay up?
prefer this because they get to hang out with their friends as opposed to hanging out with our friends.
Yeah.
And so we did the whole, 9 o'clock is the same as midnight by turning on
Yeah,
the
that's what
TV. Dropped
that's
some
what we do.
balloon. We dropped some balloons, which was kind of a little bit of a bust the way I set it up. But the kids had fun because there was a million balloons all over the ground, so they're
Yeah.
all hitting it at each other and throwing it at each other.
That's
Yeah,
fun.
but I was in bed by I don't know 10:30. I'm gonna say
Yeah, me too.
slept through all the fireworks apparently because I had heard from different people saying, "Oh yeah, the fireworks were kind of loud." I was like, I didn't hear them.
I
Um,
New Year's and 4th of July, it's like living in Baghdad or something. It's like
yeah,
cannon shots going off. We did the
worst
same
if you
thing though. What's that?
definitely worse if you have dogs. You have to deal with
Oh,
that.
yeah, yeah. Yeah. No, we were there was no we quit doing New Year's stuff years ago. It's amateur hour if you go out, and the prices at restaurants are out of control, and we just we just don't do it. We don't do it anymore.
Yeah.
And you know what? We wake up on January 1st, refreshed, rested, ready to go for the new year. Well, I will say it seems like the market went out on New Year's because it woke up on the first trading day of the year with a bit of a hangover.
Yeah. Yeah.
Nasdaq down
Well,
nearly 2% on the first trading day.
we I will say we got a nice ending overall for the year. So I will definitely take everything as a whole.
Yes, yes, absolutely. I'm just saying, you and I stayed home while the market went out late because it's hungover. All right, let's dig in. All right, welcome back, everybody. I'm Brian Ullman, joined by Ryan Louie. We're both advisors at Ford Financial Group, if you don't know us already. This is the Casual Friday Financial Insights podcast, where we do a chart review. We'll review some charts. We're going to take a little bit of it. We're going to deviate a little bit from the norm in that we're going to do a little bit of a look back and an outlook today. If you are listening to this, wherever you listen to podcasts, or even on our website, if you're listening to it, and you haven't subscribed already, click the subscribe button on Apple Podcasts, Spotify, Ryan's Overcast, wherever you're listening to podcasts. If you're watching the video version of this on YouTube, I'd say subscribe so that way you can catch us. We cut these every other week, and we'll have some other stuff sprinkled in, like some of the webinar replays if we're able to, client events, things like that. So if you watch this and you have questions that you'd like us to address at some point, if we're able to, you can email us info@forwardfg.com. The email address should pop up right here on the screen, and then we'll have it in the show notes, both on YouTube and in the show notes for the podcast as well. So you can email us at info@forwardfg.com. Before we're digging into the market's hangover and 2024 outlooks and things like that, we can't start the year without talking about New Year's resolutions. You have a New Year's resolution?
Yeah, mine's pretty simple.
Okay.
Actually, I thought about it just to have one, I suppose. For
Sure.
this year, we have some friends that we've been friends. My wife and I have been friends with for a couple decades, and prior to having kids, we would actually like have dinner with them every single week. And of course, as you have kids, that kind of dwindles. But we ended up having dinner with them. I don't know. I would say maybe it was like September or October. And when we did, we realized like we hadn't seen each other in 11 months. And
Yep.
they live a few miles away from us. And so that kind of stood out to me, that we shouldn't have let that happen. So my resolution is to actually make a bigger effort because to spend time with friends and family. Um, we I'm notorious for going through the weekend and just kind of go in coast mode, do what I want to do this stuff at home, kind of chill out at home,
Sure.
but not necessarily make the effort to like contact people to make sure that we have dinner with them, at least occasionally.
Yeah.
And so that is going to be definitely my step forward this year, is to contact people, make an effort, not necessarily rely on other people to do it for me. I tend to do that.
I think that's a great resolution. I have a few of them, and one of them is similar to yours in that I need to do a better job staying in touch with old friends. My daughter asked me if I'd ever made sushi before, because she's all into sushi now. I said no, but my old roommate from college would make sushi, and he was a really good chef. And she said, "Oh well, can you have him teach you?" And I said, "I haven't talked to him in a long time." She goes, "Well, when was the last time you talked to him?" And it occurred to me, I mean, we've a couple texts here and there, but I haven't seen him in 9 years. And I'm like, this is too much.
Yeah.
Even just the phone call, "Hey man, how you doing?" out of the blue. I need to be more deliberate about that. I have some other stuff too that, whether it's exercise, I want to play more singles tennis instead of just doing doubles.
Okay.
But one of them is also to do a better job of staying in touch with old friends. So I think you and I are moving the same wavelength with that one.
Yeah, I think it's just important, especially because we have families. I think sometimes I honestly sometimes think that becomes a crutch though. You use that as an excuse. Oh, I'm busy.
Yeah, it's easier to be
I'm too
lazy.
tired.
Yep.
But realistically, you can make effort for these things, especially again, we're obviously deeming these important. So if they're important enough, we got to just make the effort for it.
For sure. For sure. Henry's New Year's resolution was more adventures. It's pretty wide category. He wants to go on more adventures. It's pretty wide category, but I think I'm going to try and help him with his adventures, whether we are doing traveling a little bit more, or just adventures around the neighborhood. I don't know what it is, but it doesn't mean sitting on the couch in front of the screen. So
that's a good one though.
More adventures is the coolest one I've heard.
A bit broad. You might be surprised what you find out when you actually hear it. It might actually not be as adventurous as you even think.
I know. Well, when your kid says more adventures, you can't say anything but hell yeah, let's go. Let's do it. Right. Well, good. Maybe we'll try this again as we wrap up 2024. We'll see how we both did. We'll hold each other accountable for our.
We put it out there a little bit differently when you're doing it on a podcast and putting it out there versus somebody casually asking you what your New Year's resolution is. So maybe that'll help us stick to it a little bit better.
There you go. I hope so. I don't know if we can allow comments. If YouTube has comments, I'd be curious if you're watching this, if you got a New Year's resolution, to put whatever your resolution is in the comment, just to see kind of how ours stack up with yours. Let's talk markets a little bit. I think in the last one of these, we discussed going over the outlook for 2024, and LPL has issued so of course we work with LPL Financial, and their research department, along with every other research department under the sun, has issued an outlook. You're not a research department if you don't look in the crystal ball and try and put out whatever the outlook is, or your outlook is. And so LPL has said in 2024, they believe that markets will make a definitive return to a more recognizable place. We're still feeling the hangover from the COVID stimulus and rates, and then rate increases and so on. A risk of recessions bubbling up again, they say, as post-pandemic stimulus wanes. From their perspective, the turning point for markets and an economic landscape can be characterized as a return to familiar economic and market patterns, leaving behind the volatility of policy and economic swings from the last few years. I don't know about you, but I look forward to that.
I think it would be nice to get back to a more normalized market, and that you could argue what a normal market really is, because the world is never normal. But you definitely, I think we spent these few years going through the markets that had to deal, and it tied very much to what was happening from COVID, or as you mentioned, then the stimulus came, and then you had the economy jump up because everyone was spending their money, and now we're getting maybe a point where everyone has spent all of their stimulus money. There's nothing left in savings. And so it'd be nice to just be able to move on from, what all happened during COVID, and the markets are now going to eventually get to a point where they're not tied to everything that was happening back, those few years.
Yeah. I mean, I would like some normalcy. I can tell you that whatever normalcy is. But you're right. Everything's been tied to. Well, we've gone over ad nauseum, kind of where, or at least, we've reviewed charts where spending is off the charts, savings is down to zero, interest rates are going up while people are financing things. So I think this is something that we've discussed a little bit, and we've been in a place where we're talking either there's a recession or a soft landing, meaning there's some slowing, but doesn't meet the standards of recession. But at that point, who cares? You either have an economic slowdown that doesn't meet the definition of recession, or you actually have a shallow recession that meets the definition but isn't too fierce. LPL says in 2024, we believe a recession is likely to emerge as consumers buckle under debt burdens and use their excess savings, but that a Fed that is sensitive to risk management might provide offset by taking interest rates down again in the new year. So this is a good chance for us to talk rates.
You have been talking about this for a while too, though. I feel like we've spent many podcasts with you talking about a recession, feeling like it was going to come in 2024. Yep. And so,
well, and I was, it didn't come in 2023. I think probably this time last year, I thought it was going to be in 2023.
I definitely think it's coming down to, some of the things that we talked about. You just mentioned, with interest rates being high, you end up spending more money on interest, less it will be, than you are spending on actual goods or services, because you have to pay for those higher interest rates.
Right.
They'll eventually eat, you either eat into the amount of discretionary income that you have, the amount of savings that you have.
Yep.
And, one of the things that LPL was talking about was just the amount of money that people were spending in 2023, which does elevate the economy. It kept it strong, but it doesn't really believe that the consumers are going to be able and willing to spend the same amount of money at the rates that they were last year going to, throughout 2024, which then causes a recession. And hopefully if we do have one, it's like they said, hopefully it's a mild one.
Holiday spending was the same this year as it was last year by early estimates, but the conditions, I would say, are worse after having inflation and everything. I have nothing to support this idea, but it had the feel of like everybody getting one last hurrah over the holidays, going hog wild. Costco's full of people, and deliveries every single day to every single person by Amazon. But you turn the corner on this new year, and it wouldn't surprise me one bit if people start cutting back. And I think a lot of we're getting into the markets a little bit, but markets seem to be pricing in solid earnings growth and no economic slowdown. And I got to agree with LPL on the economic point. I don't think that's going to happen. They mentioned that the Fed's sensitive to this, and so right here we're looking at the Federal Reserve dot plot. So this is the dots represent individual FOMC member projections. So the people who are making these decisions are projecting where rates are going to be. And then the line is the median kind of visualization of all of these projections. And they're looking, they themselves are predicting a 75 basis point cut here this year. According to the dot plot, and even further still. Even the Fed is saying it, that they're going to cut rates.
Yeah, well, that's what propelled the market the last couple of months of the year. I think that whether or not there's a recession still probably plays into how far those interest rates actually come down. I think you have both sides of the argument thinking I've read that some people, economists think that even if we have a recession, they're not going to just slam down, interest rates to combat it. But I definitely think, in my opinion, it would probably come down more than what's plotted here if we actually had the recession come into play.
Yeah, so that's a good distinction though that you're making, because there are two things. If inflation comes down, that's one thing. They want that to happen. If a recession comes, that's a different thing. And inflation coming down, I don't think would cause them to lower rates, because now they're using their ammunition, or they're using they you don't need to turn on the fire hose if you don't have a fire. And if there's no recession, there's no reason for them to do it. But if we do have a recession, that's certainly what LPL is suggesting, and that's what I've been. Maybe I'll just say, I won't say I was wrong. I'll just say I was early. But if you have a recession, it's not just inflation alone, or the reduction of inflation, or easing of inflation, that's going to do it. And I think that's what futures say. And so this slide that we're looking at is the Fed fund futures rate. So this is what futures markets are believing the Federal Reserve is going to do, versus the last one, which is the Fed. This is what the Fed was saying in their dot plot. This is what the futures markets. This is a bit of we've looked at this chart before. It's a little bit of a tricky one. On the left, it's talking about the number of 25 basis point cuts, essentially, here with this. And the right is the implied Fed fund rate. And so if you look, even just you ignore the number of cuts, because it doesn't really matter how many times they cut. We talked with one bond manager that says, when the Fed hikes, it's 0.25% usually. When they cut, they'll start slashing and cutting in between meetings. So the number of cuts don't matter quite so much. But futures are talking about the Fed fund, implied Fed fund rate, being nearly 5% as early as the beginning of March, and being 4.8 at the beginning of May. Those are substantial cuts that would need to take place in the first 3, 4, 5 months of the year.
Well, even as you get to the right side of the chart, that's just the right side of the chart. It's just the end of next year, basically.
Well, the ascend was, yeah. So it jumps to December and then January. So 1 year from now, essentially.
Yeah.
3.5. You're talking about a 200 basis point cut over the next 12 months. If they're doing that, they're doing more, probably, right? Wouldn't you think?
Yeah, most people kind of believe that, it's either they gradually do it, and if they're gradually doing, small cuts, then it's like it's usually the economy is probably doing well. They're trying, inflation's in check, but they know that they need a lower interest rate, so they kind of do it at a methodical pace. Or the other side, like, happens where you have a recession, and they drop it 200 basis points in a matter of a couple of months, and they're trying to, like, revitalize the market and the economy ASAP.
Is the Fed ever early?
No.
Or even on time?
No.
They're late.
No.
And so what you get is you get some, like, really surprise big, unemployment goes up slowly before it goes up quickly. And so suddenly we have the unemployment rate rising and economic slowdown going, and they'll just come out both barrels in May and be like, we're going to cut it 75 basis points.
Right. Right.
That's what I think is going to happen, is that they're going to be just like they were late raising rates. They're going to be late cutting rates, and they're going to wait till they see the whites of the economy's eyes and say, oh, we really are in a major slowdown. We got to cut. And so economically, we might have a slow year this year in 2024, right? Unemployment rising, economic activity slowing. But for markets, it could be okay. It could be
Well, the one thing the Fed has that they haven't had in a while is a lot of ammunition, right? Because raising these interest rates over the last couple of years have give them a lot of ammunition and room to move those interest rates down, which can stimulate the markets. It's a much different situation. If if they had raised interest rates and we were sitting here at like 1.25%, 1.5%, and a recession comes, they can't do a ton of, to really help move that economy back into place, because lowering interest rates 1 or 1.25% just won't do a ton.
No, what do you say? It's like pushing on a string, right? It can't. It's not going to make a difference. But think about this, because we're not talking as economists here. We're talking as investors. Whether it's Joe with mortgage rates, or whether we're talking about what's going on as with people and their 401ks or their retirement accounts, or even their trust accounts like they do with us. A lot of people, I had more money market activity with my clients in the last 12 months than I've had in the last 15 years.
Same.
Money markets, CDs, high yield savings accounts, all that money came off the sidelines. Now, high yield savings accounts, money market, that's a floating rate, and it's going to start floating down. CDs, 3 month, 6 month, 9 month CDs, they're all going to mature and roll over. And that rate that someone's going to replace that with is not quite as good. So you have money potentially coming off the sidelines, especially if rates are being cut. You have markets moving higher, probably. So you might have that sideline money coming in. And additionally, you have mortgage rates. Let's say mortgage rates go from, God, they're as high as 8 to 7 to 6 to maybe 5.5. Now you see that now you see real estate activity start to pick up. So from an investment perspective, yes, unemployment might be higher. The things that are causing the Fed to cut rates are in play. And if you're worried about your job, that's a whole different ball of wax. But if you're an investor, it could kind of pose an interesting outlook where you say rates are coming down. I can't get 5 or 5.25% risk free any longer. It's now going to look a lot closer to like 3 or 2.5. Maybe I need to go buy fixed income now instead of buying money market. I don't know. I think that could have an effect on things.
Yeah, I think it's well, you think about how it played out when interest rates were going up. It could be the opposite when interest rates go down, which is, when interest rates were going up and you can get 4.5, now 5+% interest. People were taking money from their investments that had risk, right?
Yeah.
And they were thinking, okay, well, I'm happy with taking basically no risk and getting these interest rates.
Sure.
But again, that's when interest rates were going up. And then now that we may be in this environment where interest rates are going down, there's going to be points where certain clients, and every client's going to be different with their number, right?
Of course.
Some may say, I'm okay with the 3% interest. Some people, another client may say, I'm not fine with 3% interest. I'd rather move this into something else now, right?
Well, let's get real. There's also some FOMO that goes on where you're like, now I was getting 5.5 or 5.25, 5, whatever you were getting. I'm not getting anything, but you can look at your core bond fund in your investment portfolio and it's at 9.
Yeah.
You say, okay, well, I still don't want stocks, but maybe I want some bonds. And
correct.
And that's what coming off the sideline, I think, would look at, especially for a lot of retirees. They say, I don't want to ride this roller coaster anymore, but man, you can't pass up what core bonds do when interest rates are falling. We'll talk about bonds in a second. We're kind of getting into the stock market. I will mention stocks here. LPL says, as far as stocks are concerned, interest rate stabilization should help support stock valuations. And while rates may be the most impactful driver of stock valuations, profits are moving into a sweet spot. Here's what I underline. Stocks look fully valued at current interest rates, but if rates ease as we expect, there's an upside to year-end 2024 fair value target range of 48.50 to 49.50 on the S&P. What's that?
So to give perspective on those fair valuations, 48.50 ish, we're talking 2 to 4% from where we are upwards,
yes,
right? So
that's what I was going to say too.
But so from a valuation standpoint, is someone saying, on the upside, we have a little bit of room, but not a lot. Before you start to get to the areas where the market starts to get expensive, and no one wants to be in that area because when we know things are expensive, they tend to pull back to become cheaper again at some point.
Yeah, well, specifically, they say we believe stocks will provide mid to high single-digit returns in 2024. But the S&P is essentially at what I mean, as of the first trading day of the year, S&P is at 47, closed at a little bit more than 47.42. We go up 100 points on the S&P. Is that
yeah,
mid single digit?
Yeah, right.
What? I think the reality here for stocks is that it's probably going to, you come off a year where you're up into the 20% range for the S&P, even more for NASDAQ. We went over this last time at a multiple that's higher than the historical average. You're not going to get that back to back.
No.
Like rates come down, we might go higher. You think we're going to get another 20% of the S&P this year?
No, because I think the problem is that the way that one way in which you would get to really high returns on the stock market is, yes, interest rates go down much lower than we expected. The problem is economically something's probably wrong, right?
Totally.
So this the counterbalance. Like if the Fed were to somehow, without the economy being bad, lower interest rates to 2%, yeah, I think we're going to have a great stock market. But like, why would they do that? They won't do that unless something's broken. And so that's the reason why it's hard to imagine that we're going to have these high, really high stock returns this year.
Right.
Based upon being fairly valued, based upon interest rates aren't going to just plummet without having some kind of catalyst that's going to be a detriment.
Yep.
It's likely kind of just maybe slog along.
Well, and I think if you look here, just at annual returns and pullbacks for the last this, so this is the S&P 500 for the last, I don't know, few decades. And this is current through year end last year. You go back and look here at years where we had returns in the 20s. Now, this is not artful science here, but you just look, well, obviously 2021, we were up 27%. We were down 19% the year following. What is this? 2019, we were up 29%. 2021 was down, up 16. It's not that you're going to have negative returns.
Correct.
But you're just not going to have returns in the 20s again. When we had that 30% return, it was up 11 the following year. 23% return, up 13.
Well, and reasonably, I mean, most people are still happy if they're going to get 10, 11% returns, which is all, some of these returns that you see coming off of a very good year are actually still, a solid year. Like you're not going to complain. You're not going to complain about those returns.
And we're going to get it, and you're probably going to get a drawdown of high single digit, low double digit drawdowns at some point. It's hard for me to believe that last year stocks had the largest drawdown from peak to trough was 10%.
I agree.
Didn't it feel more?
Yeah, that whole August, September, October period when things were going down felt worse. Now, I will say, I think too, why they feel worse is because we look at things, generally speaking, from a portfolio perspective, not just the stock market.
Yeah.
And so we are seeing bonds go down in conjunction with stocks at the same time, once again, for that 3-month period. And so it's like, again, it felt like we were living through 2022 all over again.
Totally. Well, it was, you're absolutely right. You're absolutely right. In fact, that's the other slide that that's the Fed slide. Here are the returns. We've talked already on this. We'll get into bonds. We might as well get into bonds now. We talked already about this, how this year, when we were at the end of October, this would have been the third year in a row for a negative returns for the aggregate bond index, which 2 years in a row had never happened before. And then we were going to get 3, and it was going to be unbelievable. But bonds rallied at the end of the year as much as stocks did. Not quite as much, but they rallied at the end of the year quite a bit. So we actually ended up getting a 6% return out of the aggregate index. And you can see how much steadier bonds can be. There's a possibility here if rates are being cut, because bonds are math.
Right? I think I know where you're going.
That bonds out return stocks for 2024. I don't think this is a bold prediction. I mean, it's a little bit of a bold prediction because you can look here and see that it very rarely happens. But it happens. It does happen sometime.
Not definitively, but there's a very more than fair chance that can happen too if we have a recession, right? Because then stocks probably go down where interest rates go lower, and then when interest rates go lower, then the bonds appreciate in value. Based upon LPL's research's thoughts, I think it definitely has a much higher probability this year than in most years.
Yeah. Well, LPL says, they kind of summarized last year. The move higher in yields was unrelenting, alongside an economy that outperformed expectations, and blah, blah, blah. Bonds had a rough time. Here's the ending here. However, the big move in yields may have already taken place, and with a potential directional change in interest rates likely coming in 2024, we believe bonds offer compelling value. I think, and something else they wrote is maybe even a more compelling value than stocks. Oh, here it is. Technically, we believe stocks are not as attractive relative to bonds. While we expect stocks to move higher from here, the distinct risk-reward profile of the two favors owning bonds. Ryan, you're in your mid-40s. Are you adding bonds to your own portfolio? I know this is not advice for everybody.
No, this is not financial advice, but no, because you don't want to go around tinkering with things when you have a long-term perspective, right? Again, the younger you are, the longer the road you have. You don't want to go in there tinkering every single year, because you're probably going to maneuver at the wrong periods of time. Yeah. And again, you're making best guess efforts, and I think really we know that when you're younger, you should be taking risk.
Well, and I think we're talking, I've talked a lot this year with clients about ripples, waves, and tides. And really, you need to be, especially with people with a much longer investment time horizon, you've got to be looking at the tides and not even the waves. And the tide, I think, especially after 2022, we are in a place where even though we're in a presidential election year that everyone is dreading, I don't care who you're voting for, no one's excited by this. You've got some really hairy stuff going on internationally with as recently as, Xi Jinping saying that the unification with Taiwan is inevitable, right? Just recently. With what's going on in the Middle East, with Ukraine and Russia. I mean, there's a lot of craziness out there. It still is a better bet long-term on stocks and on bonds. But if you are retired or heading towards retirement or even deep in retirement, chances are you own a big chunk of bonds in your diversified portfolio. And it should be exciting because after 2 negative years in a row and a touch and go year last year, you're in a place where a big chunk of your portfolio is poised to do pretty well, if not better than the stock side of your portfolio, I think. That's the exciting part here. It's not that you should be cycling out of stocks and into bonds. It's that if you are in a place where you own bonds, you're in good. You finally the clouds are starting.
You're in a place where you can let it do what you've been waiting for it to do for a while, and letting it bounce back. Plus, you're gaining the interest. Hopefully, you'll get some appreciation. I think in a perfect world, we would hope soft landing where interest rates come down, bonds appreciate a bit, they kick off the interest, and the stocks can kind of muddle along without having to deal with a recession.
Well, and I don't think it's crazy to say if the average over the last 40 years or whatever is on this chart, the average for the U.S. ag is 6%, that the ag is going to outperform its average. I don't think that's a crazy prediction. So if you're saying, okay, well, we just got done saying stocks are going to be S&P up 100 or 200 points, which is somewhere around 4-ish% maybe, but the ag's going to do well, and even if it just hits its average is up 6, that means bonds are outperforming stocks next year.
Right.
I don't know if we're going to be right, but this is kind of what the tea leaves are
This
telling us.
This is what talking about something that's going to happen over the entire year is like. We're
going to have to watch our own video and come back in a quarter or in a mid-year and say, okay, where are we in terms of things? We're in this roughly a half hour, so we'll wrap up on everybody's favorite geopolitics. I will summarize. I mean, LPL recognizes what's going on in the Middle East. What's going on with Russia and Ukraine and the stuff with NATO, China, trade war stuff with China. They don't even mention Taiwan in here, but that's kind of implicit with the trade war stuff. They summarize by saying, we're not expecting the geopolitical backdrop to get materially better in 2024. These guys aren't political scientists, though, by the way, right?
No.
As far as all the things we're going to cover, they are least equipped for this. It said, history tells us that this risk alone is not enough to derail opportunities in capital markets. And I think that is the part that they have the experience and the historical perspective to say, the world can be crazy, but that doesn't necessarily affect us as investors.
Well, okay, so I would actually extend that probably to what is going to be, of course, top of mind for everyone this year, which is the elections, right? Because I know, in fact, I got off an appointment earlier today, and that was one of the questions they ended with, which is, elections would be crazy, and I tell them a lot of times, we get tied into it. The politics actually don't affect the markets, very substantially, or if they do, it's for a very short period of time. Markets care about the economy, and so we got to keep that in mind because, again, we're going to be inundated with news, with social media, with everything that's happening with the election, thinking that all this chaos is going to cause chaos in the markets, right? And in reality, it's very unlikely to do so to the point that we would actually make some kind of large adjustment to the portfolio. Is very unlikely.
It's going to be that time of year. I mean, we are there. We're in a presidential election year, so we're going to have to start talking about. We're going to have to start covering this. I don't know if this isn't not where we're going to cover presidential election stuff, but we can put together a slide deck that lets us know how presidential election years goes. If they were going to lump this into geopolitics, I guess. I think I was just looking from the source. I think this is from the Sandbox. Oh gosh, I'm going to butcher this. Sandbox Daily. There's an email that comes out. Historically, annual S&P 500 returns have averaged 7.5% with a yearly average drawdown of 15% during the fourth year of a presidential cycle. So that's going to be this year. So an average 7.5% return and a 15% drawdown. But both of those are in line with historical averages. The S&P 500 has been lower only 4 times during an election year. 2 of those instances in recession. The seasonality trends are on par. I mean, I don't think as loathsome as a presidential election year is, it affects us as citizens, but not as investors, is what I often kind of boil it
Tell
down
clients,
to.
right?
Yep. But we'll get into the numbers. We'll prove it. I think just today's not that day. I don't know. There's not a whole lot of commentary I don't think we can provide on geopolitical stuff.
Well, I'll say this. It's impossible for us to not have an episode where we're going to have some slides in election year. And
Yeah.
it'll come. It'll come. It's just a matter of time.
Totally. What's on your mind?
So I got an Apple Watch.
Oh yeah.
I won't go into why. There was a reason why. Like, I wasn't reachable. I don't film my phone all the time when it's in my pocket. So my wife was reaching me. It was kind of a big deal, and I wasn't reachable. Well, I was, but I didn't feel it. So she's like, "You got to get a watch." So I got a watch. My one reason why I have looked into it was because of, like, measuring my fitness is always interesting to me. I like
Sure.
data, and I feel like,
Yeah.
if I measured my workouts, if I measured my pickleball. So on top of mind is trying to I've mentioned I listen to a lot of health podcasts, and like they want you to be in zone 2. Like, zone 2 is a very important measurement of exercise. And if you're in that zone for long periods of time for your exercise, it's good for your health. There's a good way to exercise. And so when I got the watch, I was playing pickleball, and it measures your zones, and I was like,
Okay.
sweet. I'm hitting zone 2 for like anywhere from like 40 minutes an hour every time I play pickleball. This is going to be easy. Then I listened to a podcast that said, in order for you to be in zone 2, to make it to be effective, it needs to be consistently there. You can't be doing this. And I know in pickleball, I'm doing this because there's times where you rest, you stop, you come back and play.
Yep.
And so I am now trying to figure out exactly, what to do in terms of exercise. It's the new year, right? Exercise, but to be effective the way I wanted to be effective is not going to be pickleball. So I will need to be getting on a bike or something like that.
Yes, you're going where I was going to go. We're really on the same wavelength here.
Okay.
It is time. You can order it on Amazon now. It's time to get the Peloton.
We actually have a pretty nice stationary bike.
Yeah, but it says on the screen, you're in zone 2.
Oh, it does. Okay. Well, I mean, I have my watch on me. I just go like this all the time while I'm on the bike. I was on the bike yesterday.
Well, what it does is it takes your heart rate range.
Yeah, so it's not really it's not the best accurate way. There's supposed to be a way to, like, measure your lactate, which I'm not going to be doing to measure your zone. But
yeah,
well, I'm trying to get a good guesstimate of being in zone 2. Definitively, what I thought was going to work, pickleball, is not the way to do it. So again, I'm turning to something else that I think will be more effective.
Yeah. Well, good. I mean,
what's on your mind?
There's not I've been under the weather. So I've been trying to keep my momentum, and start the year strong while feeling pretty crummy. So some of that has been on focusing, we started this with talking about our New Year's resolutions. What I really wrote them down, not as resolutions, and I do this every year. I write down my goals and I check them off as I go along, or sometimes, this is something Carol taught me to do a long time ago. So I can go back in my book and look at goals that I had written down in 2013, 2014, see where I am, see it. So it's kind of cool to see how far I've come. And so it's making sure not just that I have my New Year's resolutions, but I have my 2024 goals written down. And they can be goals, professional goals, family goals, spiritual goals, health goals, those kinds of things. So I think the last few days have been spent kind of just, I don't want to say in reflection, but trying to get a sense of like, what do I really want to focus my energy on this year? And one of those is like doing a better job staying in touch with old friends. Some of it's like playing singles has to do more with getting more exercise, right?
Yeah.
Because you know this, you can play doubles and kind of dog it, right? Singles
Yeah.
makes you
It's
work,
not the
and so
same.
that's some more of what that's about. But just that kind of stuff. So I think I've been focused on goal setting as much as anything for
You're
2020.
not done then in terms of setting your goals yet for this year. You
Well,
still,
I like to think that I'm never actually. I like to give myself the grace to know, like, oh, this isn't actually a goal of mine anymore. Or if you reached it and you chop it, you like, oh, well, I didn't aim high enough, or something along those lines.
sure.
Um, and so it's kind of a fluid thing. But if you don't do it, being aimless to start the year is um not something I want to do. So it's less New Year's resolution, eat less chocolate, whatever it is, and it's more. I've shaped it in terms of goal setting, um, and what those goals are going to be, whether it's for me personally, family, work, etc.
Yeah,
So
well, the one thing I think I gotta do better is not be even broad in that goal setting, even the one resolution that I have, because
yeah,
I don't want to say like I want to be more active. And again, to go back to my example of the friend that we saw once last year, late in the year, we went to dinner with. I can't definitively be like, oh yeah, we did twice during the year, and be like that was a really good effort because that was more than one. I think that I have to be able to. I like numbers. I like measurements.
sure,
I got to do something to hold myself more accountable. Which is, I don't know, like you got to do this once a month, right? Like it's not that it's the same person, but you got to make an active effort to go out with your friend, your family, or something like that
totally.
that you wouldn't have normally done, once a month, every six
Well, they
weeks, something
say
like that.
you need to have goals that are SMART, right? Which is an acronym for specific, measurable, attainable, relevant, and timely. So
Okay,
a goal needs to have an end. I need to by such and such date do a certain thing, or
right.
I need to have lunch with 5 friends before 4th of July, right? That's like,
Yeah, yeah, those are good.
that's something like
Yeah,
that. Um, well, I'll be interested in, I mean, goal setting is what it's all about. So, or I think resolutions get a bad rap because that's not actually what a lot of people are doing. I think it's goal setting and deciding and being deliberate about where you're focusing your energy. So I guess what's on my mind, that's what's been on my mind over the last week. That and taking a lot of zinc and trying to, I've been going to the gym still and working out despite feeling like crummy. Like it's next week's going to be my week. I'm going to feel better and I'll start to gather momentum next week, I guess. So, all right. Well, I think that's all we've got for our 2024 outlook or our commentary on someone else's commentary, right? Um,
yeah,
if you have some thoughts on this, email us info@forwardfg.com. That's the email address that we can address your questions to. Either we can email back to you or we can forward it on. If you have a financial advisor here at Forward Financial Group, we can forward your question on to them. You can always put questions in the comments. I think if we allow that in YouTube, if not, and you're seeing this is posted on LinkedIn or something like that, of course you can put it in our LinkedIn comments or Facebook or wherever it is that you are getting this information. So with that, Ryan, we are going to convene in another couple weeks and do it again.
yeah. Wishing everyone a good and happy, healthy 2024.
Start to 2024. Absolutely. All right. Until next time.
All right, bye.